Hello, everybody. It's Hammer. Today is January 11th, 2023. This is your vetted VA mortgage market update. So, coming to you from the road today, as you can tell. So, we're going to keep it pretty brief, but want to go over with you a couple different things. So, I'm flying solo today, no guests, but thank you for joining me. If you're here live, please go ahead and say hello. Let me know that you're here. If you are watching on the replay, do me a favor, go ahead and give us a hashtag replay. Let us know that you watched on a later date. Either way, if you've got any questions or comments, we want to hear them. So go ahead and pop them out there. I'll be glad to make sure that they get answered for you. So, first things first, let's go ahead and do a quick rate recap. Let's talk about what happened over mortgage rates over the last week. So, last week we talked on Wednesday, and I said that we could see some volatility on Friday when we got the jobs data. That was really the only thing that I talked about. And the jobs data was being looked at because the Fed has two mandates, and their job is to keep inflation at or near 2% and to maximize employment. They want to keep employment going well. Well, we know inflation's been a huge problem, and inflation has driven up mortgage rates amongst many other things. Well, in order for the Fed to get inflation under control, they've been raising that Fed funds rate over the last year. In 2022, they raised it over 4%, when that is huge. Historically, very big deal. So what happened was last week we got jobs data, and we wanted to see, is this raising of rates, is it affecting the jobs market yet? Because what's happening is in the labor market, when people make more money, when we see wages increase, we would think that that is a good thing. And in fact, it is a good thing, but sometimes good things come with bad consequences. So what happens is when wages go up, people have more money to spend. More money spent on the economy creates more demand. Increased demand feeds into inflation. Now, if this is happening in a normal environment and it's, a balanced level of wage increase, we get normal inflation that would be around 2%, which is the Fed's target, and that would be a good thing. But we've had inflation at 7, 8, 9%. So when we see wages increase, it's concerning to the markets and it's concerning to the Fed. So last Friday, we saw more jobs created than what was expected. We saw unemployment drop to even further than where it's been, and that would normally you would signal, hey, that's not a good sign. We unfortunately need to see the labor market kind of take a little bit of a hit if we're going to see inflation get into check. However, the wage data last week came in showing that wages were still growing, but growing less than expected, slower than expected. And that was very good for mortgage rates. So last Friday, we saw mortgage rates start to improve a little bit. Well, we also had one other thing happen last Friday. Now, a report that I generally don't talk about at all, the ISM services report. That tracks the services. There's ISM manufacturing and there's ISM services, and it tracks the increase in the cost of services. And this report actually came in showing that the economy was contracting, and the contraction is huge. The fact that the economy is contracting and that the reading, which was very unexpected, this was a surprise reading, it came in below 50, which is 49.8, which shows contraction. Normally we were expecting like 54, 55 for this reading, right? And because it came in on Friday after that labor market data, what that did is it actually put us in a position where mortgage rates took off. So we saw a fantastic improvement to mortgage rates last week. That is our basic rates recap. For your VA loans, it pushed VA rates back into the high fives or low sixes, and that depends on your unique situation. Of course, you want to shop around, talk to vetted VA professionals, make sure that you're finding for what is the right situation for you. But our conventional conforming loans for someone not getting a VA mortgage, they were in the low sixes, and so low to mid sixes. And then for VA loans, they were in the high fives to low sixes. So we saw some really nice improvement last week. As far as what we've got going on this week, let's go ahead and talk a little bit about our rate forecast. So we've got a really good thing coming this week as well. Now, today is Wednesday. Tomorrow, 8:30 a.m. Eastern Time, Thursday, January 12th, 8:30 a.m. Eastern Time, we're going to get what's called the CPI inflation report. It's a consumer inflation report for the consumer price index. What that is it's basically an imaginary basket of goods, and the prices are tracked month to month to see if they've gone up or down. They continue to go up because we're seeing inflation, but we have seen less and less inflation each month over the last couple of months. That's called disinflation. Now, the difference between disinflation and deflation is when the cost of goods actually go down. Disinflation is when they're still rising, but the rate at which they're rising is less and less. So, disinflation is a good step towards where we would get to actual deflation, right? And we generally may not see the price of goods go backwards much from here, but if we see them stop going up, that's a win. Now, if that report comes in tomorrow showing that we are not seeing inflation the way we have over the last year and a half, and that's a very good chance. The last two reports we've gotten have been in our favor and have helped mortgage rates to improve. In fact, we saw mortgage rates up in the mid sevens and it brought them all the way back down into the sixes. Now, tomorrow's report, if we were going to give it Vegas odd maker odds, I would say we're 80% likely to see a report that helps mortgage rates, but there is that outlying 20% chance that it could hurt mortgage rates. But I want to show you something. That report is so important because it influences the Fed actions. Now, we've got a Fed meeting at the end of this month, and February 1st, the Fed is going to announce what they call the Fed funds rate, and they're going to announce any kind of rate increase to that. And the expectation right now is that we're going to see a quarter-point rate hike, where, remember, that's the rate that has gone up over 4% in 2022. Now, the Fed members, they've been coming out saying that they need to be aggressive still to beat inflation. They have come out saying, hey, we're going to take this Fed funds rate, we're going to push it up over 5%. We're going to hold it there through 2023. But I want to show you guys something. The market does not believe the Fed. Okay. Now, this is the current Bloomberg.com. This is their current headline. Fed's no rate cut mantra rejected by markets seeing a recession. What this means is that investors, and we call it the markets, right? But investors, basically, they understand that we're starting to see signs of the economy slowing down. Tomorrow's inflation report, if we see that inflation report come in a way that shows that the economy is slowing down and inflation is getting better, despite all these Fed members saying that they're going to have to raise rates and keep rates higher, market doesn't think it's going to happen. They think the Fed is a little bit out of touch on this. It took the Fed too long to raise rates to fight inflation because the Fed didn't think inflation was there. The Fed was wrong. And now we think the Fed is wrong again. And if that happens, if the markets start to adjust and we think, hey, the Fed is not going to raise rates. And the way we track this, by the way, let me show you something else. I'm going to stop that screen share. Let me show you another screen. This is called the FedWatch tool by a company called CME Group. Okay, so this is called a FedWatch tool. And what I'm going to do is let me pull that up here and get rid of this. And let me make it nice and big so you guys could see it real clearly. Okay, so when we look at that FedWatch tool, right now in February, the expectation is almost 80%. So 4 out of 5 believe we're going to see a quarter-point rate hike. And as we get into March, they expect that we're going to see another quarter point, which would bring rates from 4.25, which they're at today. In February, it'll be 4.5. By March, it'll be 4.75. And that's where it's expected to stop. Not at the 5% that the Fed members have been saying that they need to get to. So there is some pricing in that we're going to see this bigger increase, but a lot of the markets right now not pricing in. They think we're going to stop at 4.75. They think that the last month we're going to be seeing 4.75 is in September. By November, we start to see that rate drop. That's the current expectation. Now, we don't have a crystal ball. We don't know if that's going to happen. However, this is why we think mortgage rates can improve this week. If we get low CPI data, we could see those rates improve maybe anywhere from 1/8%, which is 0.125% in interest rate, maybe 0.25% in interest rate. We could see that much improvement. It's not guaranteed, but it's possible. As we head over into the next couple of months, we head into the Fed meeting at the end of this month. If markets continue to believe that we're going to see a recession, that the Fed is going to have to ease off of all these rate hikes, we're going to see mortgage rates improve a little bit further. Now, days of 2s and 3% are gone. we would have to see the economy tank really, really bad. Remember, that was a pandemic condition caused by the reaction to the pandemic, the shutdowns, people, not going to work, those kinds of things. That's not likely to ever happen again. And we hope it doesn't because of everything that would happen to bring those conditions. However, we could see mortgage rates that get comfortable in the fives. And that would be a great spot to be. Eventually, maybe in a year, we could even see the fours. So that's kind of where the current outlook is, what we're looking at the near term, that outlook. If you have any questions, do me a favor, go ahead, put them in the comments. I'm going to monitor for a minute or two, but that's kind of where we're at today. That's what we're looking at as far as the market. That's what we're looking at for rates. If this rate update, if this mortgage market update has been helpful to you, please, if you're a mortgage professional or a consumer, a real estate agent, put it in the comments. Let us know that this is helping you, that this is what you guys want to see, and we'll keep doing it. I'll keep bringing it to you week in and week out. Rebecca, wonderful to see you, my friend. I'm so glad I could actually see your name too. So thank you for joining and watching today. If anyone else has had any benefit from this today, please let us know in the comments. Remember, we do this each and every week. You can go ahead and join us next week. If you are watching today, you're watching on the replay, do me a favor, give us a hashtag replay, let us know that you're here. If you're here live, say good morning, and we'll see you next week. Take care, everybody. If you have any questions, put them in those comments. We'll be sure to answer them for you this week. All right, everybody. Take care. Thank you so much, and have a great one. Bye-bye.